Okay, let's dive right into this. If you're gearing up for that CFA Level 1 exam, you already know the deal. Equity valuation is an absolutely massive, critical chunk of the curriculum. You literally cannot ignore it. So today, in this explainer, we're building your ultimate, targeted CFA Level 1 toolkit. Consider this your personal survival guide to totally mastering these concepts.
All right, as an analyst sitting for this beast of an exam, you need a highly organized review. So here's our roadmap. We're going to decode equity valuation, break down the dividend discount model, and then look at free cash flow models and relative valuation multiples. After that, we'll hit some real-world case studies and wrap it all up with those sneaky CFA exam traps. Section 1. Decoding equity valuation. This is the analyst's core skill. Listen, equity valuation isn't just about blindly plugging numbers into a formula and hoping for the best. It all starts with our most important baseline definition, intrinsic value. Basically, this is a company's true economic worth, and it's based entirely on the present value of its future cash flows. That single idea, it drives literally all valuation models. But you've got to contrast that intrinsic value with the market price. The market price is simply what investors are currently willing to pay for the stock at any random moment. It's the price tag, not the actual value. So, the crucial point here is that finding this exact mispricing logic is your primary job as an analyst. It's the whole shebang. If your calculated intrinsic value is greater than the current market price, well, you buy. You found a discount. It's on sale. But on the flip side, if the intrinsic value is less than the current price, that stock is overvalued. And your recommendation? Sell. Run away. Moving right along to Section 2, the dividend discount model. This is all about valuing stable dividend payers. Now, this model right here is the absolute most foundational tool in your toolkit for evaluating mature companies. Let's break down the core variables. We have P0 equals D1 divided by R minus G. So P0 is your current intrinsic value. D1, that represents next year's expected dividend. Then we just divide that by R, which is your required return, minus G, the expected growth rate. It's a beautifully elegant formula, but for the exam, you need to know exactly how these variables interact with each other. Okay, pay really close attention to this next part, because test makers absolutely love to catch you here. The DDM has some very strict limitations. The formula only works when your required return, R, is strictly greater than your growth rate, G. If it isn't, well, the math fundamentally breaks. You'd get a negative price, which makes 0 sense. It also assumes the company has a stable, predictable dividend growth rate, so you simply cannot use this model for wild, volatile tech startups. Let's move to Section 3 and see how this builds. Free cash flow models for when dividends just don't exist. So what happens when a company doesn't actually pay out its earnings as dividends? I mean, plenty don't. That is exactly where these free cash flow models step in to save the day. Notice the key difference between the two main approaches here: firm-level free cash flow, or FCFF, and equity-level, FCFE. FCFF starts with EBIT and ultimately results in the value of the entire firm. But FCFE starts with net income, and importantly, it includes net borrowing. Because it factors in that debt financing, FCFE directly yields the equity value. Keep those starting metrics explicitly clear in your head for test day. Moving to Section 4, relative valuation multiples, how we compare companies out in the real market. Instead of calculating an absolute intrinsic value completely from scratch, relative valuation compares companies against each other. It's like checking the price of houses in the same neighborhood. PE helps gauge growth expectations, while price to book is absolutely crucial for valuing banks and financial firms. Now, what's really interesting here is the EV to EBITDA multiple, because it uses enterprise value and earnings before interest, taxes, depreciation, and amortization. It strips out debt structures entirely. That makes it completely capital structure neutral, which makes it perfect for M&A analysis. So how do you actually choose the right tool when you're staring at a question? Here is a massive pro tip for the exam. Model selection is quite literally half the battle. Just walk through this logic. Step 1. Does it pay stable dividends? If yes, use the DDM. Step 2. No dividends? Use free cash flow to equity. Step 3. Need a quick comparison across the market? Turn to your multiples. Memorizing this exact flow is going to save you so much crucial time on the clock. All right, Section 5, real-world case studies. Let's look at Tesla versus Emphasis. Seeing these models in action really helps cement the knowledge before we jump into practice questions. Consider the wild juxtaposition between Tesla and Infosys. Historically, Tesla carried a crazy high PE ratio and initially had pretty low profits. Its valuation was almost entirely based on massive future growth expectations. Then, on the other hand, you have a company like Infosys, super stable earnings, regular dividend payouts. And this brilliantly illustrates how Infosys is perfectly suited for the dividend discount model, while a beast like Tesla requires a totally different framework. The market price reflects those future expectations, not just the current fundamentals. Before we hit the exam traps, let's anchor ourselves back to why this all matters. You absolutely must memorize these core relationship drivers. Knowing these will help you intuitively answer multiple choice questions without having to bust out your calculator and do complex math on the spot. So, higher growth, that equals a higher valuation. Higher risk, lower valuation. Predictable cash flows give you a higher valuation, and higher profit margins result in higher multiples. It is all beautifully connected. Section 6, CFA Exam Traps. Consider this the analyst's survival guide. All right, sit up and lean in for this part. You're about to face the test makers. And believe me, they have exact traps designed to trip you up. First trap, confusing market price with intrinsic value. Don't do it. Second, selecting the wrong model for the company's profile. Like we said earlier, don't try using DDM on a volatile tech startup. Third, ignoring the underlying growth assumptions that actually drive your results. And finally, blindly trusting PE ratios without considering the broader context of the business. Keep your guard up. Let's test you actively right now. Practice question 1. A stock is undervalued when A. Price is greater than intrinsic value. B. Price equals intrinsic value. C. Price is less than intrinsic value. Or D. Earnings are low. Take a quick second to think. Got it? The answer is C. A stock is undervalued when its market price is less than its intrinsic value. Remember, you want to buy when the price is lower than the company's true worth. Let's hit another direct practice question. Practice question 3. A high PE ratio most likely indicates A. Low growth, B. High risk, C. High growth expectations, or D. Low earnings quality. Remember, this exam heavily tests your interpretation skills. And the answer here is C. High growth expectations. Basically, the market is happily paying a premium today because they expect massive growth tomorrow. We're going to wrap up today's explainer with a really powerful final thought from the legend himself, Warren Buffett. He said, "Price is what you pay, value is what you get." Honestly, that perfectly summarizes the entire core philosophy of equity valuation that you need to carry with you into exam day. If you understand the true value and master your frameworks, you're going to do great. But before you go, I want you to ask yourself, looking at your own portfolio right now, are you just paying for a popular price tag, or did you actually buy true intrinsic value? Good luck out there, and thanks for learning with me.